Hello guys, welcome to my YouTube channel. I am your study buddy, Nompumelelo Ngobo. And on this video, I'm going to be teaching you guys basically how to read a transaction and then be able to identify the two accounts which are affected by that transaction and also be able to determine whether which transaction between the two is increasing and on which side, on the debit side or on the credit side, or vice versa, by just using two abbreviations. So this method was taught to me by my teacher, Miss Kanyile, and I'm very happy to share it with you guys. So the abbreviations are DEAD and CLIC, right? So D for debit side, E for expenses, A for assets, and D for drawings, DEAD. And then you also have CLIC, C for credit side, L for liabilities, I for income, and C for capital. So this what basically means is that under DEAD, it means that on the debit side, D for debit side. So on the debit side, things that increase on the debit side are your expenses, your assets, and your drawings. And things which, okay, so obviously, if your expenses, your assets, and your drawings increase on the debit side, obviously they decrease on which side? On the credit side, right? And also here, CLIC. C is telling you that on the credit side, liabilities, income, and capital increase. So your liabilities, your income, and your capital increase on the credit side. Obviously, if they increase on the credit side, then they should decrease on which side? On the debit side, right? Yeah, so for this example, I'm just going to do two examples in order to demonstrate how I use these two abbreviations, which are DEAD and CLIC. My first example, I'm going to, let me say, purchased. You're going to say purchased. Hope you guys can see purchased inventory for purchased inventory for 8,000 rand. So this is the transaction, right? And I'm going to give you guys 3 steps that you can use in order to identify. Okay, fine. First step, you have to identify which accounts are affected by this transaction, right? Usually, you have each transaction will have two accounts, right? So in this transaction, we're going to identify two accounts which are affected by this transaction, and then we're going to determine whether the first account is debited or the second one is debited, or the first one is credited or the second one is credited. Firstly, or in order to do that, then we'll use these abbreviations to determine which element of the financial statement does each account fall under. Okay, so let me make this easy for you. Purchased inventory for 8,000. Okay, let's say for on credit. Purchased inventory for 80,000 on credit. So now first step, let's determine the two accounts which are affected by this transaction. You know that we purchased inventory. So inventory, this is our first account because we purchased what? Inventory. For 8,000 rand on what? On credit. So we didn't buy this inventory for cash. If it was cash, our account would be blank. But now because it's on credit, it means that we received inventory, but we did not pay for this inventory, right? So then this becomes your what? Your creditor's control. So this will be our second account. So let's write them down. So you have what? You have inventory, or you can use trading stock. And then you also have what? Creditor's control, because this inventory, you bought it on what? On credit. So you have creditor's control. And then now you ask yourself, inventory. In which element of the financial statement does inventory fall under? Is inventory an expense, an asset, or a liability, or an income? What is inventory? Inventory is the stock that the company purchases, right, in order to sell it to do what? In order to generate income. So your inventory in this case will be what? Will be your assets. So inventory is an asset, right? And then you come here to debt, right? The first abbreviation I said we're going to use is debt. So you can see that A for assets, A is here under debt. And what is debt telling you? Debt is saying that under the in the debit side, your expenses, your assets, and your drawings, they increase on the debit side, right? And so what is happening here? We purchased inventory. Is inventory increasing or decreasing? Inventory is increasing, meaning that our assets are increasing because we purchased inventory, right? So on the debit side, you know that on the debit side from debt, on the debit side, D for debit side, your assets increases. So already you know that the account between these two, which will be debited, will be your inventory because your assets are increasing. You purchased more trading stock. And then now let's look at the creditor's control. So you purchased inventory for 8,000 on credit, right? You purchased on what? On credit. Creditor's control. Which element of the financial statement will the creditors fall under? Your creditors are people that you owe money to, right? Because we purchased this inventory, right? We received stock, but we did not pay. So this then becomes a what? A liability in the business because we owe these people money. We received inventory, but we do not pay for this inventory, right? So this is a liability. Then you go back to your abbreviations, which is DEAD and CLIC. Where do you see L? L is here under CLIC. And what is CLIC telling us? CLIC is telling us that on our credit side, things that increase on a credit side, it's your liabilities, your income, and your capital. But are our liabilities increasing or decreasing? So let us read the transaction to find out. We purchased inventory for 8,000 on credit. So this means that we received stock, someone gave you trading stock, but you did not pay for that stock, right? So you owe that person. So your liabilities in this case are what? They are increasing because you owe money to these people. So, and you know that from CLIC that your liabilities increase where? On the credit side. Because CLIC is telling us that on the credit side, liabilities, income, and capital, they increase on a credit side. So you know that your creditors control will be what? Will be credited. Then you're done. Then you put the amount 8,000, 8,000. So you're done for the first example. So what you have to do, you read your transaction, you determine the accounts which are affected by the transaction. So we read here, we find routing accounts as inventory because we're purchasing inventory, and also creditors control because we purchased this inventory on credit, right? So the second step was to identify which element of financial statement does each account fall under. Inventory falls under assets, and our assets are here, put debt, under debt. And debt is telling us that on the debit side, assets increase, which is why we debited our inventory here because we're purchasing inventory, meaning that we're getting stock. Our stock was increasing. And then we purchased this inventory on credit. So that is why we credited creditors control. Creditors control is a liability because these are people that you owe. It means now you owe people, your liabilities are increasing basically. And then from your CLIC is telling you that your liability increased on the credit side, right? So that's why we credited creditors control. And remember, when you read a transaction, you always get two accounts. One account must be debited, another account must be credited. Okay, let me do another example, the last one. In this example, we're going to be having 4 accounts. This is the only transaction where you will have 4 accounts, and it's the sales transaction. Most transaction you only have 2 accounts in them. So let's say for this example, we'll say AJ. Okay, I'm just gonna say sold inventory to a customer. Sold inventory to a customer on credit or cash. Let me just use on credit because cash is easy. You just you debit bank because obviously you're selling. So on credit, right? Okay, so this is our transaction. Sold inventory to a customer on what? On credit. So the first step, I just say, the first step is to determine the 2 accounts which are affected by that transaction. Right. We are firstly going to determine 2 accounts for this one, and then we'll also determine the other 2 because this is the only transaction which will have 4 accounts. It's the sales transaction when you're making a sale. Also, when you are using the perpetual system, that's the only time you will have 4 accounts. When you're using the periodic system, you only have 2 accounts for the sales transaction. So let us read here. We sold what inventory to a customer on credit. Right, sold. Sold is telling you that we're making what? Sales. Obviously, when you're selling something, it's because you're making what? Sales. You're going to receive income, right? So our first account will be what? Sorry, I almost wrote income. So our first account will be your sale. Obviously, you know that when you have your sale, you should have your cost of sale, right? You recognize your cost of sale with your sale. So let me just write cost of sale here. Cost of sale. And then you sold what? Inventory. So you're selling your stock to a customer. So what is happening to your inventory? Okay, no, let me not ask this question because now we're just trying to identify the accounts. So we identified was okay, the first account we have is your sale because you sold, and then cost of sale, obviously, because when you have sale, you must have the cost of that sale, right? You recognize your cost of sale with your sales. And then you sold inventory. So obviously another account which will be affected is your what? Is your inventory. Let me just write here. Okay, it looks like we are going to determine all the account on one go. So we sold inventory to a customer on credit, right? We sold on credit. So this customer did not pay for this inventory. Maybe she's going to pay at a later stage. We sold on credit. So the people that owe us, the people that we sell to on credit, we call them what? The debtors, right? They are our debtors because they owe us money. Understand? But their account is debtors control. So we're going to record the other account, which is your debtors control. Because these are the people that owe us money, right? They still have to pay us because this customer did not pay for these goods. We sold to this customer, but the customer did not pay. So after you have identified your accounts, I said the second step now is to determine which element of the financial statement does each account fall under. And you know that your sale, when you're making a sale, you're basically selling something to a customer in order to receive what? To receive income, money, right? That money is income into the business. So your sale is what? Is an income. It falls under income, right? And then after you've identified the element of the financial statement which sale falls under, which is the income, the second step is to determine what is happening to your sale. Are your sale increasing or decreasing? Let us read the transaction bin. It says that you sold inventory. Obviously, when you're selling, you're going to receive income, meaning that your income is increasing, right? Let us look at our abbreviation here. We have DEAD and we have CLIC. Where do you see I? I is here under CLIC, right? And CLIC is telling you that on a credit side, your liabilities increase, your income increase, and your capital increase. Where on a credit side? So obviously, if they increase on a credit side, then they decrease on which side? On the debit side, right? What is happening to your sale? You're making a sale, right? You are selling these goods. The income of which you are going to receive as what is increasing. And the income increase way on a credit side. So your sale must be what? Must be credited. So you credit your sale with an amount. Oh, I didn't write the amount here. Okay, let's just say for 500 Rand. But it doesn't matter because we're not going to do the calculation for 500. Okay, and then now let's look at your debtors control. Your debtors control, we said with it's what? These are the people which owe you money, right? These people, they owe you. These are the customers that you sold to. You gave them the trading stock that they wanted, but they did not pay. So you have to receive income from those people, right? And your debtors are what? Are the assets in the business, right? So your debtors control then becomes what? An asset. You still have to receive money from these people. You come here, where do you see A? A is here under your debt. And what is debt telling us? Debt is saying that on a debit side, our expenses, assets, and drawings, they increase where on a debit side. And they decrease where, obviously, if they increase on a debit side, then they decrease on which side? On a credit side. And then you ask yourself, what is happening to our debtors? Let's read the transaction again. We sold inventory to a customer on credit. So we sold to a customer on credit for 500 rand. It means that the people that owe us money, they are increasing, right? We have to receive money from this person. This person did not pay. So our debtors are actually what? They are increasing, right? And your debtors control is a what? Is an assets. Assets increase on which side? So debt is telling you that on the debit side, your assets increase, right? Because on the opposite side, which is the credit side, they decrease. Since people that owe us money are actually increasing because this customer did not pay, therefore your debtors control in this case will be what? Will be debited. And remember what I told you guys that for each transaction we have two accounts. One account is debited and the other is credited. You can see from here we debited debtors control because our debtors are increasing. People that owe us money are increasing, and then we credited sale because we are making a sale. Obviously, when we make a sale, we're going to receive income, right? Sale is an income. It increased on which side? On the credit side. We sold this from where? From our click, right? Also, because let's say here we're using the perpetual system, right? We're going to record your cost of sale as well as inventory. You sold inventory. You sold inventory. What is happening to your inventory when you are selling it? The stock that you have, your trading stock that you have within the business, what is happening? It is actually decreasing because you do what? You are selling it, right? Inventory is an asset. Remember from the previous example that we did, we found out that inventory is an asset, right? Because these are the goods that you're going to sell in order to generate income for the business. So once you've determined the element of financial statement of which inventory falls under, which in this case is assets, you then ask yourself, what is happening to our inventory? We are selling our inventory. Our trading stock is leaving the business, right? We are selling to the customer, meaning that our inventory is actually decreasing. When you come here, where do you see your A from my abbreviation? It's here under dead, right? You have dead and you have A for what? For assets. Debt is telling you that on the debit side, your expense, your assets, and your drawings increase. Where on the debit side, we've identified that here our inventory is an asset and our inventory is decreasing because we are selling it, right? So this account should not be debited because if we're debiting it, then we're saying that we are purchasing inventory because we're saying that inventory is increasing, right? But because we're selling it, we're going to do what? We're going to credit inventory because inventory increase on a debit side from your debt, meaning that it's decreased on which side? On your credit side. So we're going to credit inventory. I don't have space here, but I hope you guys can see we're crediting what? Inventory. And then obviously I did mention to say that cost of sale, we recognize cost of sale with your sales. So your cost of sales should be what? Should be debited in this case. Your cost of sales should be debited. To summarize what we did here, we had a transaction. They're saying that we sold inventory to a customer on credits for 5,000 Rand. So we firstly did what? We determined the accounts which are affected by this transaction. We said we sold, which means that we made a sale. So our first account was sale. Sale is an income because if we are making a sale, we receive money, which is an income in the business. So sale I, and then we said, are we, because our sales are increasing, the income is increasing within the business, so we're going to credit our sales. We took this credit from Click. Click is telling us that sales and income increase way on the credit side, which is why we credited sale. And then the contra account for sale is debtors control because this sale we made it via what? On credits. This customer did not pay cash. This customer took goods and then he's going to pay at a later stage. So that is why we have debtors control. Our debtors are people that owe us money. Understand? Debtors control is an asset, right? So we said okay, debtors control is an asset. We went to our debt. Debt is telling you that assets increase where on the debit side because the people that owe us money are actually increasing. We are going to debit what? Our debtors control. And then we recognize our sale with the cost of sale because remember we're using the perpetual system, right? If we're using the periodic system, we wouldn't recognize our cost of sale and inventory. But since we're using the perpetual system, we had to recognize our cost of sale with the sale. Right. Remember, in the perpetual system, we record continuously. We update our books continuously, which is why we also keep our records for cost of sale and inventory. Right. So we recognize our sale with the cost of sale and we debit our cost of sale. Inventory, we said inventory is an asset. Remember, that is the stock that you have in the business that you're going to sell in order to generate income. So your inventory then becomes an asset, so you're going to credit inventory in this case.